Something just shifted in the global monetary system, and most investors are completely unprepared for what comes next. When the Federal Reserve sends a signal, it doesn't just move markets, it reshapes them. And right now, silver is reacting in a way that demands attention. This isn't noise. This is a warning phase forming in real time. The question is not whether the market is changing, it already is. The question is who is positioned before the move accelerates. When you look at a Federal Reserve Chair policy shift through the lens of precious metals, especially silver, you are not simply observing a routine macroeconomic adjustment. You are witnessing a chain reaction that moves through liquidity, sentiment, credit conditions, and ultimately the valuation structure of hard assets that sit outside the fiat system. The first thing to understand is that silver does not respond to headlines in isolation. It responds to the underlying mechanism those headlines represent, which is the cost of money itself. When the Fed shifts its tone, whether toward tightening, easing, or maintaining a restrictive posture for longer than expected, it is not the announcement that matters most. It is the change in expectations about real interest rates and future currency dilution that begins to ripple through every asset class. And silver is uniquely sensitive to this because it carries both monetary and industrial characteristics that amplify volatility in both directions. In a tightening environment, the Fed chair is essentially signaling that liquidity will remain constrained or become more expensive, and that immediately feeds into the dollar funding system, where global participants rely on dollar access for leverage and trade settlement. Silver, priced globally in dollars, becomes a reflexive instrument under those conditions. Higher nominal rates alone are not the key driver. It is the relationship between nominal yields and inflation expectations that creates the real yield environment. When real yields rise, non-yielding assets like silver are often pressured because the opportunity cost of holding them increases in conventional financial models. However, that textbook explanation only captures part of the picture because silver is not just a passive store of value, it is also an industrial input embedded in solar technology, electronics, medical applications, and emerging energy infrastructure, meaning that macro tightening simultaneously suppresses speculative demand while also potentially weakening industrial output expectations, creating a dual pressure mechanism that is far more complex than a simple inverse correlation to interest rates. What most investors fail to appreciate in these Fed-driven shifts is that silver tends to react earlier than gold in percentage terms once liquidity expectations begin to change. This is because silver markets are structurally thinner, with lower total market capitalization and less deep institutional hedging compared to gold. When a Fed chair signals persistence in restrictive policy, leverage positions in commodities are often the first to be adjusted, and silver, due to its higher volatility profile, becomes a release valve for risk reduction across macro funds and commodity trading advisors. This initial phase often looks like weakness or stagnation, but underneath that surface behavior, positioning is being reset. The paper market, particularly futures positioning, begins to contract or rotate, and that rotation is often misread as a lack of interest in silver itself rather than a repricing of liquidity risk in the broader system. Then there is the dollar dynamic, which is central to understanding Fed influence. A stronger dollar, often associated with tighter monetary policy or higher relative yields in the United States compared to other economies, places downward pressure on commodities priced in that currency. Silver absorbs that pressure more visibly than gold because of its hybrid demand structure. But what is often overlooked is that dollar strength in these environments is not purely a reflection of economic robustness. It is frequently a reflection of global stress and capital repatriation. In other words, dollar strength can coincide with systemic uncertainty, and in those moments silver can behave paradoxically, selling off initially on liquidity tightening but building long-term tension due to physical demand resilience and supply constraints that do not adjust as quickly as financial sentiment. A Fed chair policy shift also alters inflation expectations in a non-linear way. Markets may initially interpret a hawkish stance as disinflationary, but the lag effects of monetary policy often create conditions where inflation becomes more entrenched in specific sectors even as headline numbers temporarily stabilize. Silver, being historically associated with monetary inflation hedging, begins to reflect these cross currents as investors reassess the credibility of fiat stability. The key insight here is that silver does not require visible inflation to respond, it responds to the anticipation of currency debasement over time, especially when policy credibility is being tested by persistent debt expansion and fiscal dominance pressures that limit the Fed's flexibility. At the same time, industrial demand for silver does not pause for macro policy cycles. In fact, in many cases, technological demand continues to expand regardless of monetary tightening. Solar panel production, semiconductor manufacturing, and electrification trends create a baseline demand structure that is relatively inelastic in the short term. This creates a divergence during Fed shifts where financial demand may contract while physical demand remains stable or grows. That divergence is one of the most important structural features of silver markets because it creates the conditions for supply stress to build quietly even during price corrections driven by macro sentiment. When the Fed tightens and slows economic momentum, it can suppress cyclical industrial demand temporarily, but it does not eliminate the long-term structural consumption trend, which continues to accumulate pressure in the background of the market. Another layer that must be considered is the role of expectations and forward guidance. A Fed chair does not only influence current rates, but also the projected path of rates, and markets are forward discounting mechanisms. Silver pricing often begins adjusting before policy changes are fully implemented based on probability distributions of future Fed behavior. When guidance shifts from aggressive tightening to a more uncertain or data-dependent stance, silver can begin to stabilize or reverse earlier losses, even if actual rate cuts have not yet occurred. This is because liquidity expectations start to reprice risk assets, and silver, sitting at the intersection of monetary perception and industrial utility, becomes one of the earliest beneficiaries of that repricing cycle. What is particularly important in the current environment is the psychological effect of prolonged policy pressure. Extended periods of higher rates create fatigue in financial systems that rely on continuous refinancing and leverage expansion. Silver, in such conditions, becomes a pressure gauge for systemic stress. When liquidity is abundant, silver often lags as capital flows into higher yielding instruments or speculative equities. But when liquidity tightens for too long, cracks begin to appear in peripheral credit markets, and silver tends to react sharply when those cracks begin to be priced in. It is not the first signal, but it is often one of the more responsive secondary indicators of stress transitioning from isolated sectors into broader market awareness. There is also a structural component that comes from the physical market itself. Unlike purely financial assets, silver has a significant portion of demand tied to real-world consumption that cannot be easily substituted or delayed without operational consequences. This means that even when Fed policy creates downward pressure through financial channels, physical demand can remain sticky. Over time, this disconnect between paper pricing and physical offtake can widen, especially if investment demand returns while supply growth remains constrained. Mining supply does not respond quickly to price signals, particularly in silver, where a large portion of output is byproduct production from base metal mining. This creates a delayed supply response function that often becomes visible only after sustained periods of price suppression or volatility expansion. When you integrate all of these elements together, Fed chair policy shifts become less about directional predictions and more about regime identification. A shift in tone signals a shift in liquidity regime, and silver is one of the assets that transitions most visibly between these regimes. In tightening phases, it behaves as a liquidity-sensitive asset with downside volatility, but in transition phases, where policy begins to pivot or lose credibility, it can reprice rapidly due to compressed positioning and latent physical demand pressure. The asymmetry in these reactions is what makes silver historically significant in monetary cycles, because it does not move in a smooth linear fashion. It moves in bursts that reflect accumulated tension in the system rather than gradual adjustments. The deeper implication of a Fed chair signal is not just about interest rates or inflation control, but about the evolving trust in the currency system itself. Silver has always occupied a unique position in that trust structure, not fully monetary in official policy terms, but persistently treated as monetary by market behavior over long cycles. When policy shifts introduce uncertainty into forward currency value, silver begins to reflect that uncertainty faster than many other assets, not because it is predicting outcomes, but because it is absorbing positioning adjustments from across speculative, industrial, and hedging flows simultaneously, creating a layered reaction pattern that continues unfolding as liquidity conditions evolve further into. Rising uncertainty in fiat confidence is not a simple emotional reaction from investors. It is a structural shift in how the global monetary system is perceived, priced, and trusted across multiple layers of capital allocation. And when that confidence begins to erode even slightly, silver reacts not as a speculative asset alone, but as a proxy for systemic doubt about currency stability itself. Fiat currency confidence is built on three pillars: policy credibility, debt sustainability, and purchasing power stability. And when any one of these pillars starts showing stress, the perception of money changes before the numbers fully reflect it, which is why silver often begins moving in anticipation rather than reaction, absorbing early signals that the broader market has not yet fully priced. In the first dimension of rising fiat uncertainty comes from the expanding gap between monetary creation and real economic output. When money supply grows faster than productive capacity, even if inflation data appears controlled in the short term, market participants begin to question the long-term integrity of purchasing power. Silver, unlike purely financial instruments, has a historical memory embedded in its pricing behavior that reflects these long cycle concerns. It does not require immediate hyperinflation conditions to respond. It responds when the trajectory of currency dilution becomes visible enough for institutional actors to adjust hedging strategies. This is why periods of aggressive fiscal expansion combined with accommodative or constrained monetary policy often correlate with sustained structural interest in silver accumulation. Even if price action appears volatile in the short run, another layer of fiat uncertainty arises from sovereign debt accumulation and the increasing dependency of financial systems on continuous refinancing. When debt levels reach thresholds where repayment is not structurally feasible, without rolling obligations forward, the currency becomes indirectly dependent on confidence rather than pure balance sheet strength. This creates a psychological shift in markets where participants begin to evaluate not just interest rates, but the sustainability of the system that supports those rates. Silver becomes a reflection of this evaluation because it sits outside the liability structure of sovereign balance sheets, meaning it cannot be debased through issuance in the same way currency units can. As debt expansion accelerates, silver's role as a counterbalance to fiat exposure becomes more pronounced in portfolio construction models, especially among those who are sensitive to tail risk scenarios. A critical component of fiat confidence erosion is the perception of central bank independence. When markets begin to suspect that monetary policy is influenced or constrained by fiscal needs, such as government refinancing requirements or political pressure to maintain low borrowing costs, the credibility of the currency system begins to shift. This does not require explicit loss of control, it only requires perceived limitations on policy flexibility. Silver reacts strongly in such environments because it is historically associated with monetary autonomy outside centralized control structures. The more constrained policy appears, the more attractive non-sovereign stores of value become in relative terms, and silver benefits from this shift alongside gold, though often with greater volatility due to its dual demand structure. Inflation expectations also play a subtle but important role in fiat confidence. Even when current inflation readings stabilize, forward expectations can remain elevated if structural drivers, such as energy transition costs, supply chain realignment, and wage price dynamics persist beneath the surface. Silver, being both a monetary and industrial metal, sits at the intersection of inflation psychology and real economy transformation. It is used in technologies that expand during inflationary investment cycles, such as renewable energy infrastructure, while simultaneously serving as a hedge against currency depreciation. This dual role means that rising uncertainty in fiat value does not affect silver in a single directional manner. but rather amplifies its sensitivity to both real and perceived inflation pressures over time. Currency devaluation trends across global economies also contribute significantly to fiat uncertainty. When multiple central banks engage in competitive easing or manage exchange rates in ways that prevent currency appreciation, the relative value of fiat units becomes unstable across borders. Silver, being globally traded and priced in dollars but demanded in multiple currencies, becomes a convergence point for this instability. Investors in different regions begin to view silver not just as a commodity, but as a standardized hedge against localized currency erosion. This creates layered demand that is less visible in headline pricing, but becomes evident in physical accumulation patterns and exchange delivery stress during periods of heightened uncertainty. Another important mechanism is the breakdown of traditional interest rate signaling. In a stable fiat environment, interest rates function as a reliable signal of economic conditions and monetary stance. However, in environments where debt levels are high and financial stability concerns are elevated, interest rates can become distorted by policy intervention rather than market equilibrium. This distortion weakens the informational value of yields, leading investors to seek alternative indicators of monetary health. Silver, in this context, becomes a quasi-sentiment indicator of currency trust because it responds to liquidity conditions that are not always fully captured by yield curves or central bank projections. The banking system itself plays a role in rising fiat uncertainty, particularly through fractional reserve dynamics and exposure to duration mismatches in bond portfolios. When confidence in banking stability fluctuates, even marginally, there is a tendency for capital to rotate into assets that are not dependent on institutional solvency. Silver benefits from this rotation not because it replaces deposits or bonds directly, but because it represents a liquid, tangible asset that exists outside the credit system. During periods where bank balance sheet strength is questioned, even temporarily, silver demand often experiences spikes that reflect precautionary hedging rather than speculative positioning. Liquidity conditions are central to understanding fiat confidence shifts. When liquidity is abundant and easily accessible, fiat currency appears stable because transactions flow smoothly and credit expansion supports asset prices across the board. However, when liquidity tightens, even slightly, friction appears in funding markets, repo structures, and short-term credit availability. These frictions are often the earliest signs of shifting fiat confidence because they reveal stress in the plumbing of the financial system before it becomes visible in headline economic indicators. Silver tends to respond to these liquidity signals with heightened volatility as leveraged positions adjust and risk parity strategies rebalance exposure to macro-sensitive assets. Technological and industrial demand trends also influence how fiat uncertainty translates into silver demand. As global economies transition toward electrification, digital infrastructure, and renewable energy systems, silver's industrial relevance increases structurally. This means that even if fiat confidence were stable, baseline demand for silver would still be rising over time. However, when fiat uncertainty increases simultaneously, the monetary demand component is added on top of industrial demand, creating a compounding effect that intensifies price sensitivity. This dual demand structure is unique among precious metals and is a key reason silver often experiences sharper cyclical moves than gold during macro regime shifts. Market psychology amplifies all of these factors through reflexive behavior. As investors observe silver reacting to macro uncertainty, they begin to interpret those movements as confirmation of underlying systemic stress, which in turn reinforces further positioning adjustments. This feedback loop is not purely speculative. It is grounded in portfolio risk management frameworks that respond dynamically to volatility signals. When silver volatility increases, risk models often reduce exposure, which can exacerbate short-term price moves, even if long-term fundamentals are strengthening beneath the surface. Another dimension of fiat uncertainty is geopolitical fragmentation. As global trade relationships become more complex and regional blocs begin to prioritize strategic autonomy over pure efficiency, currency alignment becomes less predictable. Silver, being universally recognized and not tied to any single sovereign issuer, becomes a neutral reserve asset in environments where trust between currencies is uneven. This geopolitical layer adds structural demand during periods of heightened international tension or trade uncertainty, reinforcing its role as a hedge against systemic fragmentation. The accumulation of these factors leads to a gradual but persistent shift in how fiat currency is perceived across time horizons. Short-term trust may remain intact, but long-term confidence begins to erode when policy responses consistently rely on liquidity expansion to address structural imbalances. Silver reflects this erosion not in a straight line, but through cyclical expansions of interest that align with periods of policy stress, debt ceiling discussions, banking sector concerns, and inflation volatility clusters that emerge repeatedly across economic cycles as fiat uncertainty rises. The distinction between temporary monetary intervention and permanent currency debasement becomes less clear in market psychology. Investors begin to price not just the current policy environment, but the trajectory of future interventions required to maintain stability. Silver, positioned at the intersection of monetary history and industrial necessity, absorbs this repricing through shifts in both physical demand and financial positioning, reflecting a system gradually moving toward